It's indeed a great pleasure to come your way again this evening on Business Live. My name is Emmanuel Abuaji-Wiafi, and coming up tonight, Chamber of Mines hails relocation of illegal miners from Anglo-Gold Obuasi concession as a positive development for the economy. Third quarter report indicates level of non-performing loans still going up significantly despite government's decision to take part of energy sector debts. And Stanbic Bank Ghana urges financial institutions to provide tailor-made services to individuals with assets worth at least $1 million. These are the headlines, of course, plus other stories on the program tonight. Don't go away, we'll be coming back right away with the details.
Business Live today is brought to you by GCB Bank.
Now, Stanbic Bank Ghana is urging financial institutions to provide a variety of tailor-made services to individuals with assets worth at least $1 million of its associated benefits to the economy. The bank has in this slide set up a wealth and investment unit to cater for the needs of such high net worth clients. There's more in this news desk report.
Statistics show that in 2000, only 500 individuals were worth $1 million and above in Ghana. As of 2015, this had increased by over 5 times to about 2,700, and this is said to be the highest growth in sub-Saharan Africa by far. Head of the Wealth and Investment Division at Stanbic Bank, Benjamin Mensah, says this has primarily informed their decision to establish a wealth and investment unit. He explains to Joy Business their value proposition goes beyond banking solutions.
Not a lot of banks in Ghana have set up such units that look at that segment of the market. I've done, and I think we're taking a leap where it's having a view of the client's long-term needs. Okay, having a view of preserving the client's earnings over time, or his wealth over time, have a view of helping the clients to build more wealth. It has a view of helping the client have a lifestyle that befits their status, and it has a view of ensuring that that client leaves a legacy, one to his kids or next of kin, and also to society. And that construct we call the wealth quotient, or our wealth philosophy.
But couldn't the new unit only be a duplication of the Stanbic's investment banking arm, Stanlib? Absolutely no, is the answer from Mr. Mensah, explaining the two rather strategically complement each other to the benefit of the economy at large.
So if a client comes and we have a conversation around asset management, that conversation is now taken to Stanlib. You understand? So we're not in competition. We will refer that, so the conversation with the technical experts will now be with Stanlib. If that client now wants to look at diversifying their portfolio, looking at options abroad or offshore, then we have, again, another boutique asset management house called Melvin Douglas, which is, again, wholly owned by the bank. So they, again, now come in with their solutions. So we try and present a one-stop shop to the client.
So at the end of the day, what benefits to the economy?
One is, if you're now able to help this segment, one, to continue to build more wealth. Obviously, that's adding to the economy. These guys can expand their businesses, they can employ more people, and so on. So the ripple effect comes across. If you now look at the sort of legacy side, and through us, we're now going to put in the right structures to help them to support society. That is, and the economy again as a whole benefits. If you look at the whole issue of, again, intergenerational transfer of wealth, you can see the multiplier effect.
This makes Stanbic Bank Ghana the latest in the Standard Bank Group to add wealth and investment units as a third arm of operations after similar moves by subsidiaries in South Africa and Nigeria, among others.
So let's still stay further in the banking sector, and the level of non-performing loans, also known as NPLs, is still going up significantly despite government's decision to clear a fraction of energy sector debts. That's the impression one may draw after going through the third quarter results of some listed banks. Let's now explore the issue further as we're joined on the phone lines by economist and banking analyst Patrick Stevenson. Good evening, Patrick. Welcome to Business Live. Hello, Patrick. All right, so we lost Patrick on the line. We'll still try and call Patrick Stevenson to explore the issue of non-performing loans, which, according to the third quarter reports of the banking industry, is still going up significantly despite government's decision to take part of the energy sector debts. Now, we now have Patrick Stevenson on the line to look at this a bit more further. Good evening and welcome to Business Live, Patrick.
Hi, good evening. Thank you for having me.
All right. Now, Patrick, do you think that government's decision to actually absorb a part of the government, the energy sector debt, is not creating any impact at all on the banking industry?
Well, thank you for the question. I think what we need to understand is the extent to which the debt itself accumulated. You had a case where the financial industry, i.e. the banks, had provided credit lines for various institutions, particularly state-owned ones, the VRAs, your ECGs, and your gridcos. And the way that energy sector itself operates is pretty much a credit supply chain. And so when the end of that supply chain does not mobilize the resources that is needed, then you create a certain shortage of liquidity. And so that's what has been plaguing particularly VRA and ECG. And clearly, that has created a compounded problem that we have seen. And so the backstopper of that particular cycle happens to be the government, because the claim is that the government owes the VRA and these other players some funds that have to be paid. And I think as part of the arrangements that they had for reforming the power sector and other attending issues, there was a strategy which I remember clearly that the finance minister has advocated for, and some leaders in the banking industry as well had supported some sort of a strategy to create financial instruments that government will use to mobilize liquidity and essentially relieve the financial institutions of this stress. As I speak to you, nearly between 8 and 13 banks are exposed to this sort of risk that is coming from that power sector. And so the most logical thing to do would have been to get government to, push this through to the latter. But that equally means that then the government will be piling up or restructuring the composition of its debt, as it were. The arrangements have not been forthcoming, and clearly there are calls for some sort of alarm for players and stakeholders that equally watch the industry as well. So in itself, it would have been a good strategy, because then it releases liquidity that the banks are currently trapped with, the liquidity crisis that the banks are trapped with. But we don't appear to be seeing the strategy coming forward.
All right. No. So how is it badly affecting banks' profits and operations at this time?
Well, as you speak, the majority of the banks, if you look at the cycle of operations, particularly when you juxtapose that to developments that you have within the broader economy, and the economy has been struggling since 2012 on the back of protracted energy crisis, currency instability that has plagued most of the import and trade-related businesses. And so generally, the banks that generally support economic activity have equally been prone to businesses that are primarily import and trade-driven. And so when a development like that occurs, and the economy is under significant pressure, what you find is then credit lines and facilities that the banks would have issued, majority of it begin to go bad. So as you speak, if you look at the trends in the NPL ratios, the non-performing loan ratios of the banking industry has been increasing since 2013, currently sitting around 16 plus or 19 plus % thereabout. What it tells us is that in the presence of such an exposure to the energy sector, which we thought, some relief was going to be provided to the industry via the arrangement the government was going to put together, then there would have been funds for the financial industry and the bank to turn around to support other businesses that have equally been ailing, whether they are trade-driven, import-driven, or general SMEs and manufacturing concerns or whatever. But if that liquidity isn't unlocked, then the performance of the performance indicator that measures the extent to which banks are able to turn around cash and support other economic activities becomes quite challenging. And we look at the performance that has been reported at least for the first 2 or 3 quarters of 2016, these pressures have been real. And so we thought that such a strategy would have unlocked cash so that the outlook of the banking industry maybe would have improved going into 2017 post the election. But that doesn't look clear. And so the risks that you have in the banking industry are quite real, and there could be a possible effect of that on the real sectors of the economy as well.
Now, Patrick, could this also impact or could it increase the cost of borrowing by businesses and, of course, individuals?
Well, significantly. I mean, if you look at the indicators that goes into the determination of the cost of borrowing, I mean, you have things like default risk that have to be taken into consideration. You have what the going monetary rate risk, which is equally filtered into the base rate of the bank. You equally have a concern regarding liquidity risk as well. But ultimately, the decision comes to demand and supply of funds. What are the total volume of funds that are available, and what's the demand for these funds? And so in a case where these monies are not being unlocked from the government side through any sort of arrangement, clearly there's a supply constriction on funds. If you have to balance that against the ever-increasing demand for finance by SMEs and businesses within the economy, clearly a pressure is placed on the lending rate. And so to directly correlate with the pressures you have seen in the non-performing loan ratios of banks, if you look at the trends we have in the lending rate as well, the average lending rate that has been reported by Bank of Ghana has also consistently increased. Currently it sits around 33.2%. And that clearly is an indication that cost of credit has gone up for both businesses and even for government itself, because if you look at the government's own issues, the 650 that is issued over the last 3 quarters, the short-term instruments, i.e. the 91 bills, have had lower rates, but the more medium-term, we've seen the rates jack up a little bit. And so the effect on cost of credit is quite dire, and we are aware of some strategies that are being put together currently by government and the Bank of Ghana together with the Finance Ministry to see the extent to which they can deal with the cost of credit issue.
All right.
But this
now,
is
Patrick,
the cardinal one that they have to look at if they have to make any progress on that front.
All right. Now, Patrick, lastly, before you go, are the banks also not doing anything right? Because if you are dishing out monies and you don't look for appropriate ways to collect the monies back, then you yourself have a problem. Do you think the banks have to do more? Because we also have a credit referencing bureau in place. Are these not workable enough to reclaim loans when they are given out?
Sure, I feel that's a great question, really. I mean, as financial institutions, what we would ordinarily call information asymmetry and the corresponding effects that that has on the possible adverse selection of credits that are provided by financial industry is equally something that banks have got to deal with. But if you look at the structure of the power sector, for example, you have certain guarantees. The way the power sector is structured, the government at the end of the day, we know, must some way, somehow honor all of its obligations. And so when you look at the financial statements of institutions like PRA and ECG, clearly you could have a reason to believe that whatever securities are issued to these institutions are going to be paid. Clearly when there was a certain restructuring of the institutions way back in 2014 site. Bear in mind as well that most of these facilities that we're talking about today were facilities that were issued not just last fiscal year. I don't suspect between the last 2 years any of the financial institutions is really going out and giving money to some of these public institutions because the liquidity risk, the default risk of these institutions have significantly gone high.
Okay.
And so, yes, we recognize that the banks have got a responsibility to play. But as strategic components of the economy of this country, you would equally recognize that it is important these credit facilities are equally advanced to these institutions when their operations somewhat made sense and when there's a relative guarantee that the securities that were taken on the government was going to defray them. Let's also be reminded that, in the midst of all of that, you saw some fiscal stabilization levy and some toward the recovery levy strategies that the government was putting across to help relieve not just GRA and ECG, but some legacy that equally sits within the petroleum industry, which equally have an effect on power generation as well. And so it's important to have a broader perspective of these issues before we start saying that the banks are equally not doing their job well.
All right. Thank you very much, Patrick Stevenson. That will be it for now. Patrick Stevenson is an economist and a banking analyst. Away from that, the Chamber of Mines has hailed the relocation of illegal miners from the AngloGold or Boise mine as a positive development for the economy. The Minerals Commission last month started the evacuation process towards regularizing the operations of the illegal miners. The miners initially resisted the move, especially following the deployment of a joint military and police force, but have now agreed to relocate to a newly designated site. Chief Executive Officer of the Chamber, Suleiman Koni, tells Joy Business this couldn't have come at a better time.
It is the way to go if they would comply with all the regulations which would make them be recognized as small-scale miners. Why not? In any case, the company has actually relinquished that portion of its concession to government. The government has every right to reallocate. We collaborated with government. We actually served on the movement committee when we had an invitation from government to serve on the committee. We said, why not? We are here to help resolve issues pertaining to the mining industry. And although we were so hurt, we collaborated with government. And therefore, to know that this is happening is a good thing for us, but we should just make sure that it doesn't happen again in our industry, because sometimes when you retreat, the tendency is to give people the impression that you always would want to pander to people's whims and caprices, and it's not too good.
Meanwhile, the energy crisis experienced by the nation continues to have a negative impact on industries, including the mining sector. This is set to be hampering the country's quest to maximize its gains from the mining sector for the past 4 years. In an interview with Joy Business at the recently held Local Content and Investment Forum in Accra, Chief Executive Officer of the Chamber of Mines, Suleiman Koni, said the situation is retrogressing and hitting hard on the Chamber's local content agenda.
And if you are not able to resolve the electricity challenge, then our ability to really, get a lot more out of the mining industry in terms of local content would be challenged. Because for me, caustic soda is one of the major inputs to the mining industry. But the good thing is that it finds application in other sectors of the economy as well. And then the byproducts of the caustic soda production. So I think this is our power issue. I think we need to have a look at it again and make sure that we resolve it for the long term. Because like I said, I have tried to engage a few investors, and the refrain is that until we have stable, reliable, and cost-effective power, it will be a challenge for us to exploit that resource. Don't forget about VACO. VACO is essentially the same kind of challenge. So as a country, if we really want to transform our economy, it's something we talk about all the time. We need to change the base of the economy, transform, ensure that we have manufacturing growing and all of that. The base of industry is power. So until we resolve our power issue, it's not just the availability, but how cost-effective it is. I think that it will be difficult for us to make headway as far as industrialization is concerned. Local content is not just child's play. If you do it well, we can see the transformation and the growth in manufacturing. That should be the focus. That how do you leverage local content in a strategic industry like mining to grow other sectors of the economy, particularly manufacturing and services. So that is where we should be looking at.
This is Business Live. Let's take a breather here and come back shortly. All right, so it's the beginning of yet another week, and we would like to know how our stocks are faring on the stock market, how the currencies are performing against the cedi as against the other international trading currencies, and of course our commodities. Bertha Atubiga has joined me here to tell us more. Bertha, good evening.
Yeah, good evening.
Let's start with the currencies. How is the Ghana cedi faring?
Okay, thank you very much. With the local currency, that's the CD, last week it's closed with an average quote of 3.96 to the dollar, and then 4.96 to the pound, and 4.40 to the euro. That's the average quote on the interbank market. And if you look at the year-to-date depreciation of the CD using the Gold Coast CD index, the CD records a year-to-date depreciation of 2.12%. That means that is how much the CD has lost from the beginning of the year till date. That's as of Friday, and that we can say is far better than what we recorded last year. And this was as a result of an average daily gain of 1.59% against the major trading partners on the interbank market.
Very good. Let's now go to the stocks and the equities.
Well, today's market, let me say we had quite a number of shares trading, more than 200,000 shares, 287,950 shares traded on the stock market, but we didn't see any price change in all the equities that traded today. And the market closed at 4 p.m. today instead of the usual 3 p.m. that we know. And if you compare this to previous week, you realize that the daily average trades that we have is still around that quote. And if you look at the equities that lost last week and the ones that gained, the gainers still outweigh that of the losers on the stock market. And you look at this week, what we are expecting is that the market is still going to exhibit such performances like we saw last week. We're not going to see much. And why am I saying this? Because last week we didn't see that confidence in the market, though a lot of equities were trading, but the investor confidence in the market is gradually falling out. And this is because most of the financials that are come out, some are positive, but you look at the driving force of the market, that's the financial stock index, which is not doing very well. 2 weeks ago or 3 weeks ago, we had about 4 equities returning positively to investors, and now we can count about just 2 financial equities returning positively to investors, and that is not good. You look at the financials of the financial equities, like earlier our economist said, the NPLs are on the rise, and this is going to affect the stock market. Because one, when your NPLs are rising, it means that your bottom lines are going to be affected, and it affects investors' confidence, and they tend to draw out, not to lose much on the stock exchange.
Thank you very much, Beta, for that update.
You're welcome.
Beta Tubiga is a research analyst from Gold Coast Fund Management. Now, are you contemplating whether to invest, spend, or save around this time or this year? Well, that's the dilemma of many consumers who are struggling to come to terms with the current economic conditions and the uncertainty surrounding the elections coming up in December. But the Executive Director of Investment House Data Bank, Reverend Daniel Obami Tete, insists investment is still the way out in times like these.
Interview of the day is brought to you by
EcoBank, the Pan-African Bank.
You're expecting a bright future, then you cannot put investment on hold, because when you are investing, what you are effectively doing is that you are paying the future. I hear people say, oh, I'm expecting a bright future, but the question is, how are you influencing that future? And the way to do that is when you put part of the income that comes into your hands away, and not just stacking away in a savings account or hiding it somewhere at home, but putting it in a vehicle that can grow. Because like we like telling people, money can work. Money is a potential employee. So put it to work against your future. So I'll tell such people, whether it has to do with the economic environment, whether it has to do with the elections or whatever, the question is, do you still expect a bright tomorrow, a bright future? Because investing is effectively paying for the future. And I want to pay for the future. I want to buy my future by influencing it through my investment habit. So I would say that people should not allow the fact that maybe there's pressure today, because yes, I hear people say that my take-home pay can't take me home and so on and so forth. But you see, if you can't do anything about tomorrow today, then I wonder how your tomorrow is going to be.
But Reverend, the argument is that I claim to have about 5,000 Ghana cedis in my account. I am struggling to meet my daily expenses, put food on the table for the family, have challenges with even getting transport to work. And I should still allow this money, especially when it was a contracted investment, where if I touch it today, I might lose the returns. That is the problem the majority of those out there are facing right now. And we should think about investment.
We should. And my response will be, why don't you also look at your expenditure? Because people have the habit of spending money on what they want rather than what
Interview of the